to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, we'll have full earnings coverage as GE Vernova, Winnebago, and more report their numbers. Plus, we'll hone in on the M&A boom on Wall Street and how long it can last. And we'll keep you up to date on the markets as stocks trade near record highs, but pulling back a little bit today. And speaking of which, let's take a look at the major averages here. The Dow closed at a record yesterday, but today we're down by about 113 points. The NASDAQ is trading little change, slightly to the downside. The S&P 500 very slightly to the upside. As we've been talking about, we were watching a lot of earnings news and a lot of individual movers. Here's a take a look inside the Dow today. As we mentioned yesterday, we saw a record for the Dow today, seeing a little bit of a pullback. IBM, the best performer in that index today, it reports after the close, so that's something to look ahead to. On the downside today, kind of a mixed bag of underperformers. We have Verizon, Salesforce, Amazon, Sherwin-Williams, so not really anything thematic when it comes to the biggest movers there. And let's look at the NASDAQ as well to see what we've got going on there. There too, we see a bit of a mixed picture. Again, going to equal weight it so we can get a look at some of the biggest performers. Not surprising here, Netflix is the worst performer within the NASDAQ today, down 8.5% after disappointing earnings. We're going to talk more about that in the next hour. Also disappointing earnings from Texas Instruments, down 6.2%. And some of the other worst performers are also others in the analog chip space, like Analog Devices. Microchip is on that list. On the plus side, all the way up here, we have Intuitive Surgical, those shares surging some 17%. So again, some individual idiosyncratic earnings driven movers that we are watching quite closely today. Again, if you look at the sector level, you've got energy, the best performer, consumer discretionary, the worst performer in today's session. Well, U.S. stocks are trading close to those record highs, but our next guest says the bull market has little room for error. Joining us now, Scott Chronert, Citi's head of U.S. equity strategy. His year-end target on for the S&P 500 is 6,600. Scott, it's good to see you here. So, little room for error. So far, this earnings season, yes, we're kind of going sideways here, but by and large, it feels like things are coming in relatively strong, with the banks first setting the tone, Netflix an outlier. I mean, how are you reading it, and what does that mean for where stocks can go from here?
Yeah, and good morning, Julie. Great to be on the show. Okay, so our concern going into the Q3 reporting period had little to do with the consensus expectations themselves. Going into Q3, consensus was for an 8% index level earnings gain. We've got no issue. We think that's fairly straightforward to kind of achieve, if not exceed. The degree to which we exceed, though, is we expect to be a little bit less this quarter than we did with the Q2 results, okay? So underlying fundamental trajectory is in very good shape, Julie. Our issue simply has been to what degree has this expected earnings delivery already been priced into stocks?
And what are the early indications and the early reactions this earnings season telling you in terms of the answer to that question?
It's telling us that the fundamentals are in good shape as we expect. So think of the bank earnings so far. But then we also have to keep in mind that there are going to be other macro influences that come in and can influence the price action shorter term. Whether it's this emerging concern regarding credit, whether it's the government shutdown, other read-throughs, underlying economic activity that will come in occasionally and influence things. But generally speaking, financials tend to be the first sector to give you a more significant number of companies reporting. The results there in general looking quite solid. Price action a little bit more muted because of this emerging credit concern. As we go forward from here, okay, we're going to see a broadening across other sectors. And again, the storyline is going to be one where expect fairly persistent earnings growth. We do think we'll see a little bit of negative edge come in terms of companies talking about the tariff setup, but we don't think it's anything that's going to turn into a structural headwind at this point.
And Scott, I'm reading between the lines here, but it doesn't sound like you're that concerned about these credit concerns either, that, there's sort of flare-ups, but not a fundamental risk.
You used the term idiosyncratic a little earlier, and that's the way we're looking at this. At this point, I think, yes, we're all looking over our shoulder at a couple of things. The bubble dynamics that we had with the tech bubble, and then the credit concerns we had with the global financial crisis. And so I think many eyes are looking at this. And when you see this, this instance come up, is it a canary in the coal mine, or is it the beginning of something bigger? Everything we can kind of assess at this point says, hey, look, it looks like it's mostly one-off. Of course, we have to be careful of one-offs accumulating. But I think at this point, what we got from the banks was pretty good conviction that underlying credit conditions are in pretty good shape.
And then, Scott, as you know, one of the other big debates out there is whether AI is in a bubble. This is something that you guys wrote about recently. And I've also seen lines like, okay, why are bubbles so bad? So I don't know, how are you guys thinking about it? And is this another potential risk for the market?
Yeah, I think it comes up in most conversations, Julie, and you can't get away from the discussion. And what happens when you have this magnitude of performance that we've had over the past 1 to probably 3 years now in terms of this underlying mega cap growth tech AI driver, it conjures up that bubble discussion. What we're focused on is that typically what brings bubbles to a burst, if you will, is an inflection to the negative in fundamentals, okay? So right now, our line of sight, certainly into 26 and probably into 27, and perhaps even longer, is a fairly persistent positive setup for underlying earnings growth drivers. As long as that continues, the bubble issue remains topical, but we don't think it translates into a significant market issue. Now, shorter term, which is a concern we've had going into the Q3 reporting period, expectations can get a little bit ahead of themselves, such that even if you get good fundamental delivery, it's already priced in, right? So the bottom line here in this bubble discussion, we think the AI playbook here, the infrastructure build, and then the eventual read through into a more efficient corporate America is still early innings. So we want to allow for shorter term volatility around that expectation setup, but under the surface, we don't think we're looking at a bubble circumstance at this point.
And Scott, I know your team has also written about applying what you call the GARP overlay on AI, right? Growth at a reasonable price, which I've been amusing myself by thinking of it as AARP, AI at a reasonable price. But how do you find, where do you find that at this point?
Julie, I'm much closer to the AARP connection than you are, but so let's be clear on that. Essentially what it comes down to is this notion of what's being implied in the stock price right now relative to where consensus is. And so when we look down our list of companies, this is where we go with this growth at a reasonable price. We find companies that are selling at PEG ratios that are fairly consistent with overall market averages. I'll give you an example. The Mag 7 in aggregate right now is at a PEG ratio, so this is PE to growth of about 2 times. That's about the same as for the other 493. So what's happening here is the market is fairly efficiently pricing in current growth expectations. Now, there are going to be certain companies that don't have an underlying earnings component. They're still very early in their life cycle. Those are a little bit different. But the tried and true companies that are generating positive earnings, positive free cash, that are contributing to this AI infrastructure build, generally speaking, are still in pretty decent shape in terms of, again, underlying growth, justifying where the valuations are at this point.
Scott, it's interesting that you use the Mag 7 as an example because, of course, in that cohort, there's a pretty big range of those valuations and how close they are to the average valuation ratio. But is that something that you would be advising individual investors to also look at, sort of look at things that are not outliers in terms of their valuation?
So where we go with this, I'm sort of a free cash flow junkie, if you will. I pay a lot of attention to free cash flow trends and growth drivers, okay? When you look at this Mag 7 component, now there's a couple that are probably outliers that we have to handle differently. Tesla would be an example of that. But in aggregate, when you look at these companies, the free cash flow generation coming out is is astounding and something I haven't seen in my 40 plus years of doing this. This is much different than the tech bubble, okay? So what I have is a set of companies with different phases in the way they're playing through this AI opportunity that are spending a lot on CapEx, got that, but still generating positive free cash flow, and in most cases, still reducing fully diluted share count. This is a very healthy setup, right? So these companies are spending, but not in a way that is in excess of what they're generating in free cash. They're not having to leverage up that much, and they're not having to issue that much stock to do that, which again, big difference from back in the 99, 2000 timeframe. So all told, when we look at this, the financial health of these companies is very, very compelling. And so they're in a good shape to continue to spend and have it be persistent so long as those underlying free cash flow trends persist. Big focus for us, and it kind of permeates the way we're thinking about large cap U.S. equities more broadly right now.
Scott, great to see you. Thank you very much.
Thanks, Julie.
Much more markets action coming up. You are watching Market Catalyst. Stay with us.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching Netflix, 3M, and AppLovin. First up, Netflix shares are down about 8% this morning after the company missed Wall Street estimates on both revenue and profit, citing a tax issue in Brazil that weighed on margins. But analysts aren't bailing. A slew of firms from Bank of America to Morgan Stanley reiterated their buy and outperform ratings, pointing to the company's long-term strength in ads and technology. Still, Wedbush trimming its price target on shares to $1,400 from the prior $1,500, but the firm did maintain its outperform rating, and that new target still implies a roughly 13% upside from here. Next up, 3M. Those shares are up about 1% after Morgan Stanley upgraded the stock to equal weight from underweight. Analyst Christopher Snyder is saying that growth expectations are now well calibrated across Wall Street and that the company's turnaround efforts are starting to take hold following Tuesday's earnings report. He also raised his price target on shares to $160 from $130, signaling confidence that new management is executing on its growth and margin plans. And finally, AppLovin, the stock edging higher after Deutsche Bank initiated coverage with a buy rating and a $705 price target. Analyst Ben Black calling AppLovin's ad tech best in class, noting its push into e-commerce advertising could unlock major growth and potentially beat Wall Street's estimates through 2027, even with modest market penetration. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves and those top calls throughout the session.
Now time for some of today's trending tickers. We are watching GE Vernova, Winnebago, and Six Flags. First up, GE Vernova reporting mixed results for the third quarter. While the company missed on earnings, it did report stronger than expected total revenue, just shy of $10 billion for the period, as overall power demand remains strong, despite some weakness in its wind business. GE Vernova also saying it expects a larger share of its gas turbines to be bought by hyperscalers. About a third of early-stage investments are from large tech firms investing heavily in AI. Next up, Winnebago rising after swinging to a profit in its fiscal fourth quarter. The maker of recreational vehicles reporting net income of $13.7 million in the period compared to a loss of just over $29 million a year ago. While Winnebago noted more consumers are opting for affordable vehicles, it was able to use targeted price increases to offset the decline in revenue. And finally, Six Flags, which trades under the ticker FUN. Activist investor Jana Partners is joining with Super Bowl champion Travis Kelce for a campaign that now holds roughly 9% of Six Flags Entertainment. Jana saying the group plans to help improve park performance, while Kelce shared in a statement he is a lifelong fan of Six Flags. The shares still down double digits for the year by about 45%, and they're only up about 1% today. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. M&A activity topping $1 trillion in the third quarter, and the deal-making surge continues. This week, medical diagnostics firm Hologic announced it's going private in a deal worth up to $18.3 billion. We also, of course, had Warner Brothers Discovery announcing it's considering selling part or all of itself. So let's take a deeper dive into the market and what's driving that M&A activity. Scott Sperling is with us, THL Partners co-CEO. Good to see you, Scott.
Nice to see you. Thank you.
So we have seen this resurgence in deal activity, in IPO activity as well. Do you think that it is going to be sustained through the fourth quarter and going into next year?
I would think so. In fact, I think there's significant momentum building up. You have a combination of companies that are looking at how they can change the fundamental dynamics of what they have through mergers and acquisitions of entities that can help them grow faster, become more efficient, deliver their products and services to their customers much more cost effectively. And you now have a regulatory environment that is significantly more rational than what we saw in the prior 4 years. And I think the combination of those two things has given strong impetus to a reinvigorated M&A market. And then you can combine that with the fact that the debt markets are incredibly cooperative right now. While the base rate is higher than it was when money was free, the spreads are as tight as they've ever been in history, and terms are quite good. So whether it's a private equity acquirer, so-called financial sponsor acquirer, or it's a corporate to corporate deal, I think you're going to continue to see significant uptick in deal making.
And Scott, there has been concern broadly about the private equity business that it's going to be harder, it has been harder to do exits, to get money back to folks who are investing. Does this mean that outlook is also considerably brighter?
I think you're going to see more exits occur because of this dynamic. I do think that in the industry overall, you've seen a period where valuations of companies that were acquired, particularly in 2021 and into 2022, were such that it's taken more time to grow into the kind of expected returns that you have, and therefore there were a lot of companies that were just not quite ready to have a realization event. And you're going to start to see more of that happening, I think, over the course of the next couple of years, as that large inventory of companies that was acquired in that 2-year period will become mature enough for a realization event.
Scott, I'm also curious, you're certainly not the first person to talk about the regulatory environment getting better, and that's one of the favorable things. Well, what's the risk of the pendulum swinging too far, which tends to happen, right? After you have what people see as too much regulation, then maybe does it go too far in the other direction?
I don't think we've yet seen that over excess the swing in that negative direction. That's not to say it couldn't happen, but I do think that the regulatory authorities, FTC, DOJ, most of the policymakers and the legislative side are all very focused on, again, a rational and prudent set of antitrust policies, with really a return to focus on the fundamentals of that policy, as opposed to just saying no. So we're not yet seeing that issue. Obviously, there'll be a few things happening that we'll see how the regulators react right now. But I think people are fundamentally looking at what's best for the customers, what's best for the consumer at large, and is there a prudent rationale for some of these consolidations?
Right. Scott, I also have to ask you about private credit and just credit more broadly, because as you know, there have been some concerns there. I believe you guys sold your credit portfolio, but now you're back in that business. I mean, are you seeing any signs of stress or any reason for alarm in that market?
So we had built a rather large private credit subsidiary where we had the opportunity to sell it to somebody who was trying to build a much more diversified public and private debt kind of entity. When that non-compete came off, we made the decision that for us, really continue to focus on the opportunities in the private equity side was much more attractive. I would say the dollars flowing into the private debt market has made that a very attractive market for deals across a very wide range of size, whereas it used to be a market that was focused on small to mid-sized transactions. The scale of that whole sector is such that they can do very large transactions. In both cases, they were basically filling a gap that was opened up when the banks pulled back. The banks have now gotten very aggressive as well. So I think what you're seeing is a credit market with both private debt players as well as the traditional bank players all coming into the market to support M&A, to support the build out of infrastructure that we all know is happening at a pace that is unparalleled, to support generative AI and the expansion of IT in general. So you have a very large debt market with a lot of very competitive players all looking to put their capital to work. I don't think you've yet seen any significant systemic issues in that market. There will always be that one-off or two-off, if you will, kind of crises that occurs where companies, for reasons good and bad, have failed and have hurt the value of the debt that has supported those companies. And I think that's what you've seen. I don't yet see it as a systemic issue.
Gotcha. We'll continue to monitor, of course. Scott, always great to catch up with you. Thank you.
Nice to see you. Thank you.
Thanks. We got all your markets action coming up. Stay tuned. You're watching Market Catalysts. The Fed is widely expected to cut interest rates 2 more times before the end of the year. And as yields edge lower, many ETF investors are seeking out funds that can set them up for financial success. They want some yield among these income-oriented ETFs. Joining me now, Jay Jacobs, BlackRock U.S. Head of Equity ETFs, for this week's ETF report. And I know you guys have seen, Jay, first of all, good to see you. I know you guys have seen big growth in fixed income ETFs as well, but there's more than one way to skin a cat, so to speak. And with yields going lower, is that really what's driving this interest in some of those income-producing vehicles?
Absolutely. Investors are looking to diversify their sources of yield, especially if rates start to come down. You can't necessarily get as much yield from just being in very safe short-term treasuries. Investors are looking at things like covered call, or what we call premium income strategies, where you can give up some of the upside in your stocks in exchange for higher yield. An example of this is Bali. It's our iShares premium income strategy. And it still has a lot of upside opportunity in U.S. stocks, but it's also delivering a yield that's about twice that of the average dividend-paying ETF. So you get a little bit of your cake and eat it too, growth with income.
And have you seen a lot of increasing demand for that as interest rates have been coming down?
We have. This has been one of our faster growing active ETFs this year, and we've also seen across the ETF industry this has been a very fast growing category. So certainly there's investor interest in this to complement things like a fixed income portfolio, traditional dividend ETFs, et cetera.
And is it also serving a bit of a purpose now as well? Like, for example, I think of the increase in prices we've seen in gold. Yes, it's paused the last couple of days, but just this idea of, yes, I'm going to ride my growth stocks up, but maybe I'm going to buy a little protection over here. Is it viewed that way also?
A little bit, but that's where we see things like buffer ETFs really coming into more portfolios. For example, a lot of these strategies buy protective puts to be able to defend against certain downward moves in the S&P 500. We just launched one, STEN. It protects against the first 10% in a sell-off in the S&P 500, and to fund some of that protection, you give up some of your upside potential. But for investors who've been sitting on the sidelines for years watching markets reach all-time highs, this can be a great strategy to kind of leg into the market, but with a measure of protection in case we see a near-term sell-off.
I always wonder who these people are who have been sitting on the sidelines for years watching stocks go up.
Well, it's $7 trillion. They're certainly out there, but I think it's been painful, right? When you watch the news, when you read the newspapers, when you look at a lot of the fears that are out there, it doesn't paint the best picture for why you should be invested. But for many investors, staying the course, staying invested over the long term is a great bet. So for people who've been watching on the sidelines, I think there's a lot of FOMO, if you will, that they haven't been able to participate in these markets.
Yeah. So one of the biggest areas that people have been participating is in AI. And I know that's another ETF that you guys are focusing on, is an actively managed AI ETF. BAI, I believe, is the ticker on that. What is the argument to be actively versus passively involved in AI stocks?
Well, you could look at it from either approach. I think the advantage of an active ETF like BAI is that our portfolio manager, Tony Kim, can really look under the hood at these companies and understand which companies are leading in the development of revolutionary technologies that play into the full AI value chain. A lot of people know the Mag 7 stocks. Obviously, they're famous. Obviously, they've been driving a lot of returns. But there's a long tail of companies in semiconductors, in data owners, in digital real estate, in power that play a really important function in the AI ecosystem that an active manager can just better identify and look under the hood to add to an ETF like BAI.
And incidentally, I was asking myself this question about active versus passive, and I was looking at BAI versus the QQQs, which some people view as a proxy for, it's the NASDAQ 100, or even the Mag 7 ETF that's out there. And I think BAI has done better year to date than those guys. So is it just a matter of trying to capture as much upside as you can?
It is. I mean, this is a long-term growth play, but again, it can look much more broadly than just the Mag 7. So this ETF has done tremendously well. It's raised almost $7 billion in its first year. Its birthday was actually yesterday. And so clearly it's resonating with the market where a lot of investors, they have Mag 7, they have the tech sector. They want to get more laser focused on the AI value chain because this is really a generational technology that we think is going to continue to carry markets for the long term.
Jay, good to see you. Thanks for coming in.
Thanks for having me.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. GM shares extending gains after jumping about 15% on the back of a profit beat and guidance raise. Yahoo Finance executive editor Brian Stasi spoke with GM CFO Paul Jacobson about the results, tariffs, the company's EV plans, and more.
I think this is just a testament to the resiliency of the GM team. When you look at what we've done over the last several years in terms of reducing our inventory levels, being lean, and being able to respond quickly to the changes around us, this is just another example. And as we started the year, tariffs were all the noise, and we said that we were going to be able to adjust and work through it. And now we're on a track to be able to lean on that track record and ultimately look to a 26 that could be better than 2025.
If we were to have this conversation in April, when the tariffs first hit, I think this would be a different conversation. But I mean, tariffs are still impacting your business, right?
Yeah. So we revised We revised our guidance downward on the tariff side by about $500 million. So tariffs are getting a little bit better, but I think the important message for the street is that it's stabilized. So as we look at Korea getting finalized, and hopefully as we get into 2026 with Mexico and Canada, and then the announcements that the administration just made on Friday with the expansion of the MSRP offsets, we really feel like we can be successful in that. And it's an administration that really wants the U.S. auto industry to be successful.
Within your business, where are you seeing the most pressure from tariffs?
Well, I think we've seen it across the supply chain overall. We announced $4 billion of capital expenditures over the next couple of years to bring more more assembly into the U.S. and onshore. So that's really what we've had to do is adjust to that. So as we work with our suppliers and we work with our own manufacturing footprint, that's something that over time we think we can get back to the 8 to 10% targeted margins in North America.
That, $4 billion hit this year, or $3.5 to $4 billion gross impact from tariffs this year, is that the run rate investors should expect for next year?
So for next year, we still haven't given any formal guidance yet because there are a lot of things that are changing. What we do know is we have an extra quarter to lap in 26 versus 2025. But with the Korea deal being finalized and what we would expect tariffs to go down from 25% to 15% as that deal gets finished, and then whatever can be done in Mexico and Canada, we think that there's a lot of opportunity for tariffs to be stabilized. And then when you apply our self-help, because we've said now that we can get about 35% of those tariffs met in the business by go-to-market strategies, by our manufacturing footprint, and by really focusing on discipline in our fixed costs, we think that net tariff burden next year can be lower than it was in 2025.
I talked to a lot of CFOs, and this has been an environment where teams have had to get creative. You're not necessarily going to raise prices on a piece of apparel because consumers are stretched. Like, where have you been able to creatively raise prices to help offset tariffs?
Well, I think, we've got a new model year that has just come out, and, with every model year, we've got opportunities to add content and create value for the consumer. So I think we've been able to do that across the board. But I think it goes back to that discipline strategy. So our incentives were about 300 basis points below the industry average. And that's a testament to the quality and the refinement of our vehicle portfolio. We've got a lot of strong demand that allows us to lean into that and work with our mix on our trucks and our full-size SUVs to help bring up some of that revenue and that margin performance to help offset it.
Is the consumer resiliency surprising you?
I wouldn't say it's surprised us. I think, at the end of the day, we've had a lot of strength that has really kept up for the last several years in the face of a lot of adversity. So many of our customers across the board, we've seen increased demand for higher trim levels over the years, et cetera. It's held up pretty well. But also when you look at our portfolio, we're also at the low end of the cost side on vehicles with the $20,000 Chevy Trax, for example, that we've had tremendous success in. So I think being able to be a global producer that allows us to package a portfolio of vehicles across the consumer spectrum has really served us well.
GM CEO Mary Barra talked about in her shareholder letter for earnings onshoring or reshoring of jobs. Walk us through how this will unfold over the next few years in terms of bringing jobs back to the U.S. and will you be building more plants here to support that?
Well, really what we're doing, Brian, is kind of shifting some of the undercapacity that we had in the U.S., filling that up and shifting that to other plants globally. But Orion is a great example of that. This is a plant that we were bringing up for a lot of EV demand. That's clearly not going to happen over the next several years. So instead of continuing down the path of making a lot of EVs that the customers maybe aren't ready for at that level of demand, we've shifted that into internal combustion engine production. Gives us a little more incremental production on full-size SUVs, but allows us to domestically produce a lot of full-size trucks that are going to help to ease that tariff burden going forward. So that'll come online at the end of next year in early 27, and we're very excited about that. And I think it'll be a big win for our customers.
In this regard, are the president's plans working?
I think they are for us. I mean, he's always supported the U.S. auto industry, and I think this is a really important industry for the country as a whole. And as we look at that tariff burden, making sure that we raise the concerns about ensuring that we're competitive with all the importers that are in the market, things like the MSRP offset expansion have really helped us in a way. I mean, ideally, would we rather not have tariffs? Probably. I mean, our margins would be about 300 basis points higher, but this isn't something we're making excuses for. We're just going in and trying to perform, and we think we can be on that path to get back to 8 to 10% margins.
If I read the earnings release correct, Paul, a $1.6 billion charge almost for the EV business? What are your EV plans and why are you scaling things back?
So, if you look at what we've done over the last few years, we were building a lot of capacity because the regulatory environment was pushing us into a world where we were going to have 40 to 50% EVs required by 2030. Clearly, natural demand hasn't gone there. We've seen some increases in that. We're seeing a little bit of an adjustment right now as the consumer realizes that the $7,500 consumer tax credit has gone away. So it's going to take a little while for that to stabilize, but we think it will grow naturally, but it'll be much slower going forward. So we've got to go in and fix and right-size some of that extra capacity that we think we're going to have for the next 5 years. That'll allow us to be more efficient with our incremental production and grow in relation to where demand is going to be. So the $1.6 billion in the third quarter represents some capacity at Orion, some tooling and some equipment, as well as the CAFE credits, which the president changed earlier this year. So as we look at that and filling that up going forward, we still have a little bit more adjustment to do on total EV capacity, but we think it'll position us to win for the long term.
Are EVs still a viable business longer term?
Yeah, we think for sure they are. When you look at the success that we've had, we've clearly established ourselves as the number 2 producer of EVs in the United States market.
I mean, they're good.
And I had a ride in a Cadillac Escalade IQ this morning. It's an amazing
I know, I saw it parked outside the New York Stock
across
Exchange.
the board.
It was great,
so we can help you get one if you're interested in purchasing one.
You.
But it's a vehicle that has all of the range and all the performance capabilities, and I think it is going to be the future. This slower demand is going to give us an opportunity to improve our battery chemistry and our form factors, realizing thousands of dollars per vehicle of savings, and ultimately be in a position to scale up as the consumer does. But we think they're going to win in the end.
One number among many that caught me by surprise was the performance of GM Financial. I mean, profits up year over year, but this comes at a time we've seen the Tricolor bust, we've seen First Brands bust, concerns about people not being able to pay off their auto loans. How do you see this unfolding from a GM perspective over the next year?
Well, Susan Sheffield and the entire GM Financial team do an amazing job of making sure, number one, they're serving our customers, but number two, they're protecting and strengthening their own balance sheet across the board. So when you look at the credit quality of the loan portfolio as well as their availability to consumers, I don't think there's anybody better in the captive industry than what the GM Financial team is doing. And it's clearly been a strong asset for us in helping to be creative to meet our customers where they are.
Do you see a problem happening, though, in the industry? We heard CarMax even talk about people not making car payments. Like, how bad could this get?
Well, we've got mostly significantly a prime portfolio, so we've seen a little bit of changing in delinquencies, but nothing that is really different to the sort of pre-COVID era where a lot of customers had money in their pockets after the COVID grants and so on that went out. But we're not seeing anything that's unusual in terms of delinquencies across our customer base.
Shares of Coca-Cola rising after the company reported earnings for the third quarter and reaffirmed full-year guidance. The company reported higher than expected earnings per share and total sales roughly in line with street estimates. For a closer look at this morning's report and what's ahead, John Murphy's joining us. He's Coca-Cola Company President and Chief Financial Officer, and our Yahoo Finance senior reporter Brooke DePalma here as well. John, thanks so much for being here.
Good morning. Nice to be back.
So I'd like to talk a little bit about volume versus price, because it seems as though the sales increase was due largely to price increases. What does that tell you about customers' capacity to absorb those price increases? What are you seeing?
Yes, well, overall, we had a very solid quarter, and as you said, driven by good pricing and also good mix. Our pricing around the world is pretty much in line with inflation. And in this quarter, we saw the benefit of brands and categories where higher income consumers are engaged more with. Brands like Topo Chico, Fairlife, and Smartwater here in the US outperformed and gave us a nice tailwind for the quarter. On the volume front, you got to get underneath the headline number, look at performance by region, and look at the consumer segmentation we have in different parts of the world. Typically our developing markets is where we would see stronger volume performance. This particular quarter, we've had some headwinds in Latin America and in parts of Asia that have dampened the volume demand. But overall, we were pleased to post a positive volume number overall.
John, you mentioned something that we've been hearing from other executives as well, and that's that the high-income consumer continues to be able to spend here. Break down, are you nervous at all that the high-income consumer will pull back? And also, you introduced those mini cans, and that seems to be doing really well for you guys, too.
Well, a huge part of our strategy is to meet the consumer where they are and to offer choice, not only from a brand perspective, but from a package perspective, across the many channels of business in which we operate. Higher income consumers, I think, are a little bit more resilient, a little bit more inelastic. So they're more in the business of looking for new choices on the brand, on the beverage front itself. It's at the lower end of the spectrum where I think we would be more focused in ensuring that we keep lower income consumers in our consumer base. And that's where our whole revenue growth management strategy comes into play, being able to adapt with different pack options, different absolute price points across the various channels in which we operate. So very pleased with the ongoing momentum that we see at the higher end, and very focused over the coming weeks and months to stay close to that lower end consumer.
And John, on that lower side, what should we be watching for from Coca-Cola to continue to meet that customer where they are? Anything new that you all are working on to try to adapt to maybe their price sensitivity?
Yeah, you're going to have on the package front, you will continue to see different pack size options that allows our bottling partners to offer solutions at different price points. And it's really important for us to understand the consumer psyche when it comes not just to percentages, but comes to absolute numbers and being able to reach a targeted absolute price point will be a core part of what we continue to do going forward. We also, of course, have to continue to invest behind our brands to have them be more appealing. We have a great lineup in the fourth quarter. As always, as we head into the October period, Fanta has become synonymous with Halloween. And then we, of course, will have our usual plethora of great initiatives to celebrate Christmas. And then going into 2026, we're super excited about the World Cup coming here to the United States and the engagement that allows us to bring to the many people who are very passionate about the game of football.
John, there's certainly lots of momentum that has the street excited this morning. Last time when we spoke in July, we were talking about that plan to reintroduce real cane sugar. Where are we at now with that?
Well, that plan continues to move ahead full steam. In fact, we are rolling it out as we speak in a few markets here in the US, with the plan for that to phase into many markets in the course of the next number of months. So we're excited about adding that variant to our portfolio. There's a lot of interest out there, and we look forward to seeing how it does.
Minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. As we take a look at the major averages here, we've seen some sideways to now slightly negative movement today. Earlier, things were a little bit more mixed. Right now, the Dow is off by 120 points or so, coming off a record close yesterday. The S&P 500 off by about 1/5%. The NASDAQ leading losses off by about 0.5%. One of the reasons why the NASDAQ is underperforming today, Netflix. Those shares down sharply after earnings here. Right now, they're off by 9.5% after earnings, and revenue missed the company's own estimates. I want to bring in Jason Bazinet, Citi Media and Entertainment Senior Analyst, to dig a little bit more into this. And I know, Jason, it's great to see you. I know a lot of analysts who cover the company were not overly concerned about this Brazilian tax charge that the company took. That's one of the reasons why it missed. What I'm curious about is the sort of surprise that came with it. In other words, do you have any questions around how well or not they communicated that was coming in advance?
No, I don't have any questions. I mean, they rightly pointed out that those risks were disclosed in the Ks and the Qs. I think why did they announce it now? It was really because there was a court ruling in Brazil, which essentially widened sort of the applicability of this fee. Netflix's view was that if there is a Brazilian subsidiary that is buying services from a U.S. subsidiary, but there's no transfer of technical assets, that the tax doesn't apply. And what the courts ruled in Brazil is it does. And so based on that court ruling that happened for another company, not Netflix, I think they appropriately recognized the charge.
Jason, do you think that the drop today is overdone?
At one level, for sure. At another level, no. I think it is overdone in that it's sort of that $620 million charge is the accumulation of this 10% Brazilian tax across 22, 23, 24, and half of 25. So it's a much smaller magnitude. But it's probably not overdone in this sense. I mean, everybody, most of my clients that work at these pod shops, they all have a very clear narrative about why they own a stock going into a quarter. And the narrative, undeniably, going into this quarter, was Netflix was going to raise their full year guidance on operating income. And with a $620 million charge, that didn't happen. And so the fast money is going to get out.
And do you think the slow money, so-called, will be rewarded, Jason? I mean, excluding that charge, do you think that the underlying business is strengthening?
I wouldn't say it's strengthening. I'd say it was a solid quarter, but I would just note that if you looked at their revenues by geographic region, about 40% of the revenues is in US and Canada, and the revenues were sort of growth rate on FX neutral basis were stable. But in the other 60%, APAC, EMEA, Europe, the growth rate is decelerating. And so I will just remind your viewers that part of the reason Netflix's stock did so well in 24 in the first half of 25 is everyone was running around looking for stocks that were AI risk-free, DOJ risk-free, recession risk-free, and tariff risk-free. And Netflix checked all the boxes. And so we saw this unbridled multiple expansion. The stock has been trading sort of sideways until last night's report because they have to grow into that multiple expansion. And what we're looking at around the corner is potentially decelerating growth.
Well, and Jason, if you're looking for a company also that is more recession resistant, this is a time where Netflix is becoming more reliant on ad revenue, right? So how does that then play out?
Oh, I think it's fine. I mean, the way I think investors look at it is, will you still be able to grow, right? And Netflix probably did $1 billion of ad revenue last year. They're on track to do $2 billion this year, but that comes against a $50 billion of total revenue. So even if you had a recession and ad spending went down, let's say 10%, that would be sort of a $200 million headwind. But I think Netflix's belief is as the ad tier grows, that $2 billion is going to become $3 billion, $4 billion. So it would dampen your growth on the ad part of the business, but it would still be a growth driver because it's such a embryonic growth engine for the company.
So I guess then the question is, what would it take for Netflix to re-accelerate or accelerate its growth from here? Would it be, for example, buying a new content library from, for example, Warner Brothers Discovery?
Yeah, I don't think that is would accelerate the growth necessarily. I think it would probably make Netflix far more efficient in terms of the content spend to get the level of engagement. So it wouldn't really help the top line, but would they have to spend $18 billion on content if they were fortified with the intellectual property of one of the most iconic studios? And so I think it would not help the top line, but it would help their margins. That's the way I would think about it.
So I guess that then takes me more directly to Warner Brothers Discovery. And what do you think is going to happen there? Do you think that ultimately Paramount is going to prevail and buy the whole kit and caboodle, or do you think it'll play out differently?
Well, I think the most important thing to remember is that I think of Netflix as the winner, but there are sort of three loser apps, is what I call them, which is Paramount Plus, Max, and Peacock. The important thing is that that's an odd number. And so if you have one of those, Warner Brothers, go up for sale, and you have two potential suitors, Paramount and Comcast, one of them is going to emerge potentially the winner, but whoever really doesn't have a viable strategy in the future of video delivery, which is the web. And so that scarcity, that sort of kingmaker sort of swing factor that Warner Brothers as a company provides, whoever is the winning bidder, is going to accrue to Warner Brothers shareholders, right? Because they're going to be the kingmaker. So we've suggested, because it's almost existential for Paramount, that there's a 60% chance that Paramount walks away as the winner. But our number two is Comcast at 15%.
And so if what you're saying is true, if Warner Brothers Discovery is sort of the kingmaker, there have been reports that they've now rejected 3 bids from Paramount.
Sure.
So it makes sense, given what you're saying, that they are in a pretty strong bargaining position here.
Yeah, here's the math I do real simply. What we laid out when we said what could Warner Brothers get sold for, I think we said $23 to $28 a share. And there's something that was a little bit squishy in how we came up with that, and I just called it the scarcity value. And it was I don't know, $6, $8, or $10. And clients ask me, where do you get the scarcity value? And the answer is pretty simple. Let's just do the $10 scarcity value number. Warner Brothers has 2.6 billion shares. That's $26 billion. If you look at the market cap of Paramount or Warner Brothers, they're both sub 50. Netflix is $450 billion. So the question is, would you pay $25 billion to potentially have a shot at becoming a $450 billion company? I think the answer is yes, and that's the way at least the way I think about the scarcity value for Warner Brothers.
That may be squishy, but it makes sense to me, at least, Jason. Thank you so much. Great to see you, as always.
You bet.
All your markets action coming up. Stay tuned. You're watching Market Catalysts. Workday announcing a new custom AI library complete with agents to help businesses analyze contracts faster. Software companies are turning to agentic AI in their bid to compete with OpenAI. Workday saying it plans to win that AI agent race. And joining me now on this, Workday CEO Carl Eschenbach and Yahoo Finance Executive Editor Brian Sazi with me as well. Carl, it's great to see you.
Good morning, Julie. Good morning, Brian. Great to be back with you.
So I'm always curious at exactly how this stuff works. So this new product you guys have, let's say I have a contract I need to review. How exactly does it work? What does it do for me?
Well, a lot of contracts out there that people have in the enterprise are what we call unstructured data, and they're hard to bring in. Someone actually has to physically review them. We can use AI to ingest that contract into our library or our database, and then we can review it. We also have now a contract negotiation agent. So think about how much time, effort, and energy a lawyer puts into redlining a contract to go back and forth. Because now you have this library with all of your contracts, you know the terms you want to have in a given contract. So now you can compare a new contract to the terms you want, redline it automatically, and then push it back to the party you're negotiating with. And that's all automated. And you take all that mundane work of lawyers reading their contracts, redlining them, and doing that back and forth. You automate that. So the productivity you gain for your attorneys is incredible, and it reduces your cost to serve the business as a whole. That's just one example of many different AI agents we're bringing to market.
In the past month, you've been very aggressive with rolling out new AI products, announcements. How are they being monetized?
Yeah, so it's been monetized multiple ways. In fact, at our Rising User Conference, which I was talking to you about earlier, Brian, that we had in San Francisco, where we celebrated our 20th birthday, we had over 30,000 live people in attendance. We rolled out a new pricing model for AI agents. We call it Flex Credits. So a company or a customer can buy a pool of credits, which gives them 100% access to all of our agents. Our agents are built into the platform, so all of our customers are entitled to all of our agents. And because now they don't have to buy each agent or buy a capacity of each agent, they buy credits, and those credits can be used for any of our agents. And as they use our agents and they see more value and there's more usage, they burn down those credits. So it's almost like a prepay, if you will, for a capacity, and then you burn them down through the usage of our AI agents, as well as our API access to the platform. It's a powerful new licensing model. It takes us away from purely seat-based licensing, and it's something our customers have showed really strong receptivity to.
Is it moving the earnings needle for a Workday?
I think over time it will have a really nice impact on our business. I think there's a narrative out there today, Brian, that if you're a seat-based licensing company, that AI is going to be very disruptive to you. I think that narrative is false, if I'm honest. I think it's overblown. I think people like us are uniquely positioned, and AI is a tailwind for us, not a headwind, for many different reasons. And this new licensing model will allow us to monetize our agents more aggressively in the future. I will say, though, today, we are already seeing significant adoption of our AI agents. 75% of our 11,000 customers today are already using AI from Workday, and 70% of our new sales include AI or AI agents into our customers. So we're already monetizing it. This is just new pricing and packaging. It's a business model transformation, and it takes us away from being purely based on seats to a new model for AI.
Now, going back to the example of the new contract tool, if I have ChatGPT, couldn't I just upload all my contracts there and ask it to do the same thing? In other words, what's that added value proposition?
Yeah, well, Workday, we are a system of record. We have one of the most highly curated, cleanest set of data in the world for HR and finance. And your AI is only as good as the output, right, or the input, I should say, of the data you're training off of. And our data is completely clean. We have 75 million users on our platform today, Julie. 75 million users. We're transacting 1 trillion transactions a year. That gives us an unfair advantage to bring true value to our customers. Now, we have a system of record, if you will, for HR and finance, and now we have it for all your contracts. And it's built into the fabric of Workday. It's integrated, it's not bolted on. OpenAI and all these others have really impressive solutions, but they're not a system of record. We don't hallucinate because of the cleanliness and how highly curated our data sets are. And now we're bringing that in for document management across your entire enterprise with something like Eversort and what we announced earlier today.
Now, Carl, I know part of the selling point, not just from you guys, but for the promise of Gen AI generally, is an increase in productivity. And I know that you all decreased your headcount earlier this year. How much of that is then being made up for by using some of these AI tools?
Well, I think there's two different questions in there. Number one, we did do a restructuring earlier this year, but we also talked about that restructuring was to give us more operating leverage to invest back in AI. And we also are now starting to look at a global workforce, trying to move our workforce closer to our customers around the world. So that's really what we've done. In fact, we're hiring as many people back as what we did in the restructuring. So I think there's a narrative out there that we did it purely because of AI. No, we did it to leverage AI and invest more into the platform as much as anything. Today, I think a lot of people, quite frankly, who are doing restructurings lean into it and say they're doing it purely because of AI. I don't think that's always true. I think people have overhired over the last 5 years coming out of COVID. They're restructuring to drive operating leverage in the business. That being said, everybody, including us, across every single function in the enterprise at Workday, we are leveraging AI. We're getting operating leverage, and we're using those operating leverage in those cost savings to invest in the business to drive growth for the company, also for our employees. We don't believe AI is going to replace humans. We think it's going to drive a step function change in human productivity, and we're going to amplify human performance, not replace it. So I think, and definitely me, Julie, I have a different view that we're going to, take out 20, 30, 40, 50% of our employees because of AI. I just don't see it. We're going to actually amplify human potential, not replace it through the use of AI.
Maybe I can channel your VC background a bit here. Some of the valuations we are seeing on private companies tied to AI, even in OpenAI, I mean, they're not making any money, but they're signing big deals. Do things feel frothy to you?
Listen, I'm not in the venture business. I'm still a partner at Sequoia and help them when I can. But I do think, valuations are frothy. I do think over time, that's not uncommon when you have these, big tectonic shifts and there's a massive amount of private capital going into these businesses. But I think that will kind of play out over time. And I think it will be a rich opportunity for folks like Workday to look at some of these companies when they decide to go raise another round. Maybe their valuation expectation isn't going to come to fruition, which gives us a great opportunity to come in and potentially acquire these companies and bring them onto the Workday platform. Recently, we acquired a company. We announced it at our Rising User Conference, Sana, which is a powerful AI platform that we acquired. And prior to us acquiring it, we were also investors to our Workday Ventures business. So we're investing in these businesses ourselves, but I do think, listen, valuations are a bit frothy, there's no doubt, but that's not uncommon in some of these kind of big tectonic.
But you're not willing to overpay. You're not willing to overpay. You still have.
We will not overpay. I think we're very curious in looking, and we're open to acquisitions. We've made 5 AI acquisitions, Brian, in the last just under 2 years, and 3 of them have been in the last, if you will, 3 months. And I think we look for companies that have great value, bring us great technology, bring us great founders and people, and they fit adjacently into our go-to-market strategy so we can amplify their growth as they become part of us.
Carl, really interesting stuff. Thanks
for
coming in to visit us. Appreciate it. Thanks so much, Carl. We got much more markets action coming up. You're watching Market Catalysts. Earnings season in full swing. So far, companies are posting strong results. Both GM and Coca-Cola topping expectations this morning. Joining us for more is Michelle Schneider, MarketGauge.com Chief Strategist. Mich, thanks for being here.
Thanks so much for having me, Julie.
So we were getting earnings that are starting to come in. By and large, they're beating estimates. By and large, they always beat estimates. But sort of reading beyond the beat or not beat, thematically, what are we learning?
Well, what we're learning is that the optimism has been warranted, especially as the Mag 7 is still starting to report now, with Netflix being the first one and then Tesla. And that the 493 other stocks in the S&P are doing better than what people thought. So that's a good thing. And of course, we have reasons to believe that even if we see some kind of a correction, and there are signs of that, especially the premier stocks may continue to do well down the road. Anything AI, of course, has been hot, and yet there's always going to be warnings. And I think as an investor, you have to be aware. What I like to say, if you're going to cross the street, you want to look both ways. And we have some pretty obvious signs to watch for, so we'll see.
And so if you're looking, what is the investor equivalent of looking both ways? Like, how do you then guard against some of those warnings?
Well, gold certainly has been one of those warnings.
Yeah. Although it's down a little bit today.
It is. It's down a lot today, actually, considering. But then again, it's another one of those things that got so hyped up. I mean, we've been bullish gold for a long, long time now. We're actually flat, watching for a correction. But that's been a reflection. You know, I like to say, if you want to see your imperfections or the market's imperfections, look in the mirror. That was gold. We also have, I know, expectations now of CPI, and nobody really knows because the government's been shut down, whether we're going to see higher inflation, lower inflation, and certainly we've seen nuanced inflation. And then you have to look at some of the inside sectors of the market. So that would be, first of all, the consumer. And even though the consumer has been robust relatively to what people's expectations might be, if we're looking at, from a technical perspective, broke down XRT, which is the one I like to look at because it's staples and discretionary, that broke down under the 50 and it has not cleared back over the 50-day moving average. So what does that mean? Right now, consumers in caution. And we have to take that seriously. And then finally, if you have to look at something like the regional banks, which people thought maybe is just one or two cockroaches floating around, but yet there may be some more concern. So you have to watch these things, and that's what I mean, looking across both ways before you cross the street.
So that's where you should be looking at warnings. Where should you be investing right now? What are some areas that you think are I mean, everybody knows about the Mag 7. What's maybe not as appreciated?
Well, one of the things we really like right now is anything to do with infrastructure. So if we're looking at energy infrastructure, I just read, as a matter of fact, that Kinder Morgan and Phillips 66 are looking at expanding pipelines. And so I think it might be time to look at some of these oil companies that have been beat up, and particularly if you can get involved with the infrastructure. So there is an ETF called Alerian, it's AMLP, and that has been also beat up, but that could really start to grow because everybody's gotten so bearish in oil, but yet we know it's a commodity. Supply demand can shift at any time. And so that's one area. Another area that we're looking at right now, believe it or not, is simply long bonds themselves because of the lower interest rates potentially coming, because of some of the recession fears with labor market, et cetera, some of the factors we just talked about, the consumer, the banks. Bonds are actually getting a really nice bid, so we're looking at TLTs.
Gotcha.
And if they're just about to have a major breakout over 90.